When many people think about a bank, they think about a financial institution that's been built to help them reach their financial goals and safeguard their money. Unfortunately, what's happened because many banks are publicly traded companies, they have a right to serve the shareholders. They look for opportunities to increase profits, and this typically comes at the expense of their customers. So they're trying to serve two masters, if you will. They have their customers on one hand that they need to provide services for, and then they need to drive up profits for shareholders. And ultimately, they have to serve the shareholder. And this puts their customers in a negative position. Because the shareholders are the bank's #1 priority, the bank typically starts offering services like a credit card with a high interest rate to drive up profits for the bank. And when we've seen this many times is not in the best interest of the consumer. So one of the problems with the bank is that ultimately they have to put the shareholder first, and that means generating high profits, and that comes at the cost of the customer. So they have now created the credit card, right, the revolving debt that puts the consumer in a negative position, meaning they're earning or having to pay a lot higher interest rate than they're getting on their own money. A consumer typically, when they open up a savings account with the bank, they're getting a very small interest rate, 1–2% if they're lucky. And on the flip side, they're paying 21%, 29% on a credit card. So the primary responsibility of a bank is to create a plan that drives up profits for the shareholders. They have customers, but their primary responsibility is to serve the shareholders. And so that plan that they've created through the years are these credit cards, revolving debt with high interest rates, because it creates enormous profits. And what we see is that our customers, they've been successful following the bank's plan to put profits in place for the shareholders. And so all we do is tweak that plan a little bit. Instead of now it being a powerful financial plan to drive up profits for the bank, we flip the tables, if you will. We get lower interest rates for the consumers, and they're able to successfully follow the same plan of making on-time monthly payments. The difference is it pays off the debt, and then it puts them in a position to have a monthly payment that they can use for their own financial future. They might choose to use the $300 or $400, the $1,200 that was going towards paying off their debt. Now they can use that for investing in retirement, financing a child's education, the types of things that they're planning for in their future.